Hi everyone, we did our monetary policy project on the years 2010 to 2015. I'm Kirsten.
And I'm Caleb.
As many of you may know, there was a recession from 2008 to 2009. Between the years 2010 and 2015, the economy was recovering from the recession.
We decided to look at this time period because we figured a lot of people would do during the recession, so we wanted to see what the aftermath of that was. And we'll start off with a few graphs to kind of display what was happening with the economy. So GDP was at an all-time low prior to, prior to our time period that we looked at. So during those times of 2009 era, it was at negative 2.5, and then it spiked all the way back up to obviously about 2.75%. So that's quite a drastic jump there, and that was kind of surprising. And then it basically fluctuates, a little bit here and there from 2010 to 2015, but overall it was pretty steady throughout. And next we'll talk about the unemployment. So the unemployment was starting to decrease during the 2010 to 2015 era, but before that, it obviously was pretty low, and then it spiked up, and obviously that gray area kind of shows that there was a recession during this time. Inflation rates, they started low and then went pretty high and then came back down. This was kind of a weird pattern, and there was really no rhyme or reason to it. Um, at the end there, you see on the far right are the annual numbers. So if you look at those, starts off at 1.6, goes to 3.2, then slowly kind of goes down, and then it goes almost to zero in 2015. So that's pretty good. Basically, there was no inflation in 2015 is what that number is telling us. And then for interest rates and the federal fund rate, real interest rates were very low, as you can see on the graph here. Um, After 2007, it really plummeted pretty far. And after that, you can see it dips even more from 2008 to 2010 or 11 there, where it hits pretty much that rock bottom of almost 1%, and then kind of climbs back up around the 2014, 2015 mark. It's on the rise, and obviously you can see going into kind of the 2016 to 2017, 18 era there, it's slowly kind of climbing back up. And then for the federal fund rate, it was at really an all-time low. I think it was roughly zero point 0.5 was the number, zero point 0.5 to 0.75 in there. So the federal fund rate was very low, and obviously that's what leads to those low interest rates. So then we'll go ahead and look at the yield curve. So yield curve will kind of predict the recessions. So anytime where there's a dramatic spike upwards in the yield curve, you'll notice that the highlighted gray areas on this chart, that's every time that there's a recession. So basically the yield curve can predict recessions, and you can notice that it's going up quite steeply around that 2008 to 2010 mark, and it remained pretty high throughout there before dropping back down.
From class, we learned four different policy tools: an open market operation, discount lending, reserve requirement, and interest on reserves. So first, an open market operation is a very important part to the policy. There are two different types. There's a dynamic open market operation and a defensive open market operation. The dynamic open market operation changes the level of reserves and the monetary base, whereas the defensive open market operation offsets the movements that change the reserves. In an open market purchase, you'll see an increase in reserves and money supply and a decrease in short-term interest rate. For an open market sale, it would do the complete opposite, which is decrease the reserves and money supply and increase the short-term interest rate. Discount lending has three different types of loans. There's the primary, secondary, and seasonal credit. Primary credit is the most common, and you'll see that typically in banks that are in a good standing position to borrow all they want as a short-term maturity with interest. Second credit is given to banks that are kind of in financial trouble and have issues with liquidity. And seasonal credit is given to meet the need of banks' vacation and agriculture areas. A reserve requirement change is the money supply, increases the reserve requirements, and the deposit will decrease, but the demand for reserves will increase, which then will increase the federal fund rate. In a reserve requirement, the Federal Reserve has the power to fluctuate this. Then there's the interest on reserves, which you would typically see starting after the 2008 recession. And this is where people are trying to borrow more and lend less. This helps increase federal fund rate.
All right, now to talk about what we think should have been, what we think should have taken place or what should have happened. We think that they should have raised the discount rate. The discount rate during this time was about 0.5 to 0.75. And by raising the discount rate, it discourages borrowing and lowers the amount of money that is in circulation. So it basically lowers the money supply. And this is a pretty easy action to take as it's decided by the Board of Governors. Also, uh, it would lead to a shift in the aggregate demand curve to the left, which would decrease the price level or inflation and the GDP or economic output. So those two would both be going down. And on the other side, it would increase unemployment because companies would want to spend less capital on their employees in order to retain some of that money to their bottom line.
After the recession, you'll see that the federal government enacted an expansionary monetary policy. In the expansionary monetary policy, you'll see an increase in money supply, increase in inflation, and a decrease in federal fund rate. This was the solution to the fact that banks lent out more money than they can borrow at the time. Some of the policy tools that were used by the feds during this time was interest on reserves, or the IOR. This gives banks more incentive to hold money when the interest rates are low. You could see in the charts on the slide that after 2008, banks started holding more reserves since there is small gaps between the black and blue line on the graph on the left. You can also see on the graph on the right that the federal government was trying to get the interest rates on the reserves back to their target rate by implementing the interest rates on reserves.
And the effects on the GDP, unemployment, and the inflation. So the actual time during 2010 and 2015, like Kirsten said, the policies that were enacted, with the IOR being the big one that was implemented specifically for this recession, the GDP increased significantly and then kind of had some fluctuations after. Kind of showed that on that graph there where it went up a lot and then kind of just flattened out, had a few dips here and there. And then inflation went up and then declined slowly as well. Um, so that price level increased and then it also decreased right back down. So inflation went prior to that in 2009 was at like 3.9%. So it was bound to go down sooner than later. And obviously it had that big dip right away and then it spiked back up. So, and then unemployment went up, obviously after a time of, economic downturn, you're going to have a lot of, places that are looking to hire after. So it went up a lot and then you could see it kind of go down steadily on that graph. So here, firms wanting to decrease their spend on their, internal capital, maintain some of that revenue. And um, after having that jump, you're going to have a lot of companies that are going to reinvest as they see the GDP and, company growth go back up.
From this implementation of the expansionary monetary policy, you'll see that financial institutes realize that they need to start holding more. They need to stop lending so that they can lower the interest rates and attract more people to come in and want to borrow. The main goal of this recovery from the recession from the Financial Institute is to develop economic stability. You'll see that there are more credits open during this time.
And with that being said, we'd like to conclude our project here and kind of just say that, we found out a lot more about this time period than we thought was there. Um, we thought there's going to be a lot of stuff for that 2008 range, but we really didn't think about after the fact. So it actually surprised us quite a bit as to, what the different statistics look like before and after and what policies were taken. Thank you for watching.